Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of hosting Lane Kawaoka. Lane is from Honolulu, Hawaii, and he has a massive following at simplepassivecashflow.com. He's a civil engineer by education and went through the normal route of, doing a professional work and doing some single-family rentals, and eventually got into multifamily syndications, earning passive cash flow. He currently controls well over 3,500 doors and has his assets in several states from Alabama, Georgia, Indiana, Oklahoma, Los Angeles, Texas, Missouri. Wow. I mean, this list goes on and on. So I appreciate your time, Lane. You want to give some background to our listeners as to how you got started and how you came about into multifamily nowadays?
Yeah, so I started, graduated college, always was told to go to school, get a good job, just like a lot of us, bunch of lies, right? So I became an engineer and started to work for a couple years, and still following that whole financial dogma of buying a primary residence to live in. I was there in this big house, but because I was traveling all the time for work, away Sunday through Friday, it was kind of silly for me to have this big house to live in by myself. So I just started to rent it out, got an old college landlord to help me property manage it. And the rents were $2,200 a month, and the PITI, the mortgage payments were $1,600 a month. And the young 20-year-old something kid, that was a lot of beer money.
Right.
I didn't really like my job. Mostly the people. People was the issue. But I saw that was my way out of the rat race. And
Awesome. And it's fair to say you got that early taste of what a simple cash flow is like. And once you kind of get the bug, you kind of see the power that, hey, can I multiply this cash flow to different, many units more? Yeah. Would that be right?
Yeah. I mean, I lived in Seattle at the time. So that property was $350,000. So if you do the math, 2,200 divided by 350,000, it was well below the 1% rent to value ratio.
Sure.
So I didn't know anything about the 50% rule, 1% rule, all those things that it's kind of talked about a lot, but it worked, and that was kind of where I got that taste, like you said.
That's awesome. And help us understand like how you scaled your business in terms of, how you came into multifamily syndications and things like that.
Yeah, so it took a while, right? Because, I mean, my net worth was like zero. I didn't have too many student debts, which I was lucky.
Sure.
So I bought the first property, and then I bought a duplex in Seattle, went down more towards like the B+ B range spectrum. That first property was an A class. And then I started to, get more sophisticated in terms of, understanding, you don't really want to buy in a primary market like Seattle or California or Hawaii.
Sure.
You're looking for more secondary and tertiary markets. So that was where I started to buy a bunch of turnkey rentals in Birmingham, Atlanta, and Indianapolis. And I got up my portfolio up to 11 rentals, I think 5 or 6 years later. So it takes a while.
Sure.
Just buying, because at the time I was able to save 30 to 50,000 a year, I'd say, from my day job.
Right.
So that was really the key. I mean, just putting that much money away, just buying properties, and those properties appreciate a little bit. That was where I got up to a point of 11 rentals in 2015.
Sure. And you touched upon several important things there, Elaine. Could you help us understand our listeners in terms of, how different markets play, like some are appreciating markets and some are cash flowing markets, and how the different economic dynamics of the states come into play and the housing prices that are around there. Could you maybe delve some light into it? And you also mentioned like some of the class that we take for granted, like a class A or a class B or a class C. So if you could help us maybe unpack some of those terms, that'd be great.
Yeah, so the way I kind of explain to my guys is, you're looking, there's kind of two markets out there. There's primary markets, which are places like Hawaii, San Francisco. I mean, in fact, probably the whole state of California is a primary
Sure.
market.
Mm-hmm.
New York, Boston, where you're at, Maryland, that's a big primary market. You're just
Sure.
not going to find the rent to value ratios necessary to be able to cash flow.
Absolutely.
Like that property in Seattle was $2,200 a month divided by 350,000. That was like 0.6% rent to value ratio.
Mm-hmm. Mm-hmm.
Here where I live now in Honolulu, Hawaii, it's worse. Like you're talking less than 0.5%.
Absolutely.
So
Absolutely.
we're targeting markets that we call secondary and tertiary markets. Some people call these second tier and third tier markets.
Sure.
Others might just call them, just not the sexy, cool places to live.
Sure.
Right?
Sure.
Places
Sure.
like Birmingham, Atlanta, Indianapolis, Kansas City, Little Rock, Jacksonville, Florida.
Sure.
Right? Big cities, larger than 100,000 population, but not the kind of the cool place I'd like to
Hang
live.
out.
Yeah, unless
Right,
you're
right.
from there, and that's
Right,
fine.
right. And I guess, the way I describe also to add to you're absolutely right. And sometimes I kind of tell people is that, hey, there are, the sexy neighborhoods, or then some are the safe, sound, cash flowing, income producing properties that you can drive easily, live safely, and still, the housing prices are modest enough that the rental income can cover your PITI, like, principal, interest, and taxes and things like that. And still you come out, ahead, like, you can save some positive cash flow. And I love the, the website that you have, Simple Positive Cash Flow, that says a lot about your philosophy of investing and how you approach these different things. So there's definitely truth to be that. Now, help us understand, Len, that how a busy professional can kind of start to unpack this jargon of investments, like how they can kind of, enter into passive investments and invest their hard-earned cash. Could you help us understand some of those dynamics?
Yeah, I mean, part of it is like, I go by like the 70-20-10 rule.
Mm-hmm.
In corporate America, a lot of HR departments use this framework. So 10% is like the academic stuff. So like podcasts, books. 10% is nothing, right? But I think
Sure.
most times people are kind of swimming in self-help books and
Mm-hmm.
podcast. Sometimes people like listen to like 2 years of podcasts and they can talk more than I can. And I'm like, dude, how much properties do you own?
Correct.
Oh, I haven't bought it yet, right?
I know.
The
Lack of
20%,
action. Yep.
right? The 20% is, how much people, you have in your network. Because, when you're starting out, you don't know too much. You might be book smart, but another rule I have is you don't buy anything until you have at least one or two people that is in your personal database that you can kind of call a friend that calibrates you. Right?
Sure.
Because you can know about primary markets, secondary markets, A, B, C markets, classes, neighborhoods. But if you've never done it before, you're likely to be a little bit off.
Sure.
Or maybe a very off. So having those people in your corner is critical. And then the 70% of it is just doing it. And that's why I suggest most people starting out, unless you're an accredited investor and above, just buy a single family home. I mean, there's so much in the learning process to go through.
Absolutely. And I think you said it right, where I think there's so much to learn from your experiences, and easy entry into single family is perhaps some of the simple things that you can do, understand, like what it takes to renovate, how to handle the tenants. Then obviously there is the accounting side of things. I mean, that's for starters, And if you throw in the mix of, as you alluded to before, is that if you're buying properties in different states, how are you, managing these things remotely? The importance of property managers really come into my mind, is that they are the key and they are the sort of the quarterback of your portfolio, so to speak, right? And have you had any experiences about how you remotely managed your properties and, dealing with property managers and things like that?
Yeah, so when I first started out and I was doing single family homes, I had, 3 big areas: Birmingham, Atlanta, and Indianapolis. And I had 3 different property managers in those areas. I normally like to, you always have like the bigger companies, they'll manage 1,000 plus units. I usually like to go to a little bit more of the boutique companies where I work with the actual owner and principal of the company, and they actually know my property intimately.
Sure.
They drive it several times a year.
Mm-hmm.
That was just my style. And I found that pricing was a little bit better with those guys in terms of repairs. But it's no different than a lot of the guys I work with. As clients like are high paid professionals, doctors, lawyers, engineers. I mean, the doctors and dentists are, they don't really typically do this. They have staff on premises, but for a lot of guys like IT or any kind of business these days, it's all remotely. I mean, when I was working, I saw my boss maybe, I don't know, once a couple times a year for my semi-annual review, right? And then a lot of my staff, it's rare that you see them every single day.
Right.
So it's no different than a lot of the corporate America practices that you have to employ, that of keeping them accountable, giving them enough leash to make their own decisions. Say, well, what's okay? So this is broken. What's your game plan? You tell me. All right. What's the now you define?
How do you address it? Right. How do you fix it?
Now you define the scope of it. But you tell me what the schedule is.
Sure.
And you better tell me something right, because I'm going to keep you accountable to that to a T, and I'm going to measure up your milestones to get there in case you fall behind.
Right. That's important. And I think with that, you get to evaluate, how their systems are, how the people are, and are they staying on top of things and getting things done? Would that be right?
Right. But I think what I see in most new investors is they think that they can just give it to a property manager and that's it. It's
Absolutely.
like a lot of my clients, like I send them to some of my CPA referrals and they just like, all right, done. I'm like, no, you're the owner. You are the boss. You run the ship here.
Sure.
These people are just people on your staff. But, if I remember from my corporate America days, I mean, I'm guilty of this too. I'm always trying to do the least amount of work for the same amount of pay, right? So, in this case, this is your financial future. You are the owner of this. You need to tell your CPA what to do. You need to tell your property manager exactly what you want. You need to be reasonable.
Right.
Because they could fire you too.
Absolutely.
But, a lot of people, they just don't have these skill sets, right? And maybe this, this is not for everybody. But it's not that hard too.
Right. And how do you sort of, if a normal person is to, listen to this and kind of try to understand what is a class A property or a class B property or a class C property, could you help us understand what they mean and how can a person, evaluate them if they have to, kind of look into those details?
Yeah, so you can separate the grades by neighborhood class and building class. So we'll start with the building class first. So normally the best way of determining it is just on the year that the property was built. So your property is older than the 1970s will typically be class C. 1970s to 1985-ish will be a B class, and anything newer will be an A class.
Right.
And that's just, just on property building type. Construction. But you can have a C-class building that's built in the 1960s in a B-class or A-class neighborhood. So quickly going over those neighborhoods, A-class are more your luxury, yuppie type of towns.
Sure.
Class B are more your blue-collar, white-collar mix. And then your class C will be, mostly blue-collar folks.
Right.
Which is hard because most people, that doesn't really resonate too much. So the simple passive cash flow way is like, look, the A-class stuff is like where, people are running around at nighttime. It's a cool place to live. It's really safe. The class
Sure.
B stuff is, I probably wouldn't want to be out there at night.
Right.
But it's fine for a couple dudes to go walk around during the daytime.
Sure.
Class C, when I go check out my Class C apartments and houses, and I got to take pictures or do whatever, I get in and I get out during the daytime. And you wouldn't find me caught dead at night anytime after the sun goes down. And of course, there's D and F, which are the war zone properties, which
absolutely.
buy, and you usually got to pack heat if you want to go collect your rent on those.
Right. And there are some rules of investing about how you go by these things, Lane, like, what you look for and stuff like that. Could you help our viewers understand what exactly is some of the rules you go by into investing,
Yeah, so I'm a numbers guys first, right? Like I don't look at anything unless it satisfies like at least a 1% rent to value ratio. And the reason why is I kind of target cash flow first. Because when I was still working my day job, my whole goal was to quit my day job, and I needed passive income to do that. And if the rents exceed all the repairs, all the expenses, then that's cash in my pocket and I can put food on the table.
Right.
So, I've quit my job since then, and I don't technically need that much cash flow these days, but still it's a fundamental for me. That's my buy box. It needs to be able to cash flow day one.
Right. Absolutely. And how do you kind of evaluate, what repairs need to be done, or how you can increase the rent by adding some value to it and things like that? How do you kind of go about some of those aspects of deals?
Yeah, I'm no construction, or I haven't been in the trades. I haven't built houses, right? But I rely on more commercial vendors, such as property inspectors and property managers, to build me a hit list. Once they get it on a spreadsheet, I can go to town, right? We're both industrial engineers. We know how to do that. That's our jam.
Right.
And it's just a bunch of numbers at that point, cost estimates, aim high, which you have it accounted for, and try and find all the deferred maintenance items. There will be unforeseen conditions, but you try to uncover as much of that as possible and cover that within contingency.
Sure. And now speaking of the multifamily assets, right? So a lot of these multifamily assets are, kind of done in a syndication world, right? So where, you're collecting passive investors' capital, pooling the funds together and going out and buying, larger assets, whether it's, let's say, 60 unit, 100 units, 300 units and things like that. Could you help us unpack, Lane, as to how do you go about analyzing these syndications, or how do you vet an operator and things like that? So like if a normal person is listening to it, right, and an investment offering is presented to them, they wouldn't have a clue as to where to look for, or how can they understand these things. Could you help us understand how do you kind of go about vetting the syndications in these deals?
Yeah, so I'll do it how basically I do it. 50% is the person. I don't work with anybody I don't know, like, or trust. And, talking to the syndicator to me does me no good. It's just the way I see it. It's kind of a waste of time. I can talk about syndication in my sleep and give all the right answers.
Sure.
And I'm assuming everybody else can.
Right.
It's not that hard. I will only invest with somebody unless somebody in my personal network that I trust, that I have an organic relationship, can corroborate the sponsor's previous experience and have actually invested with them. Because what you'll find is a lot of people that they'll say so-and-so is good, but they haven't even invested a dime.
Right.
It makes no sense to me. But that happens a lot. The other half is the numbers, right? Like I'll take the rent rolls and P&Ls, I'll put it into my analyzer, and what I'm doing is I'm spot checking what the assumptions are, such as the reversion cap rate, the rent increases per year, and the full economic occupancy that's being assumed. And from there, I'm just trying to make sure, I'm just trying to backwards engineer what's going on here, and is this sponsor getting aggressive on their assumptions?
Right.
And are we getting to the same number at the bottom of the page? Is it truly a double your money in 5 years deal? are you truly getting that cash flow where they said they were going to be? You can find a lot of character by doing that.
Sure.
But you mentioned like, what is the normal investor going to do? Well, number one, they don't have the P&Ls and rent rolls. 90% of LPs cannot do that analysis.
Sure.
So for them, I would recommend just building up your database of other passive investors.
Sure.
Unfortunately, these guys are not at the local RIA, or they're not on some free internet forum site. Right.
On there, these are all busy professionals. Absolutely.
Right. You go to those places, you're just going to find some broke guys trying to get rich quick.
Right. Very well said. Very well said. And the part is also that to highlight is that, what assumptions are made. Like, are you like being overly aggressive that, oh, you're just projecting, something really sky high that's not going to get delivered. Like, for example, we are right in the midst of COVID pandemic right now, So if someone is, let's say, assuming, 5%, 7% type of rent growth, that would be considered extremely aggressive right now. A conservative estimate right now would be a very minimum, perhaps a flat 0 or like really 1% annual rent growth for next year or so. Would that be correct, Lane?
Yeah, I mean, the whole COVID-19 thing, I think it's a true black swan event. I mean, I know a lot of passive investors talk about it, but to me as a more long-term investor, I mean, the way I would underwrite it is that I would just do like a 2% rent increase, but that would be for a good market. But if you have like a, weaker market, like I don't know, like a Jackson, Mississippi, right?
Mm-hmm. Right.
Like I would probably underwrite it like 1.5% rent increases per year.
Right. Minimal the best, basically. Got it.
Yeah. But a lot of, like you said, when you're getting above 3% a year, you're kind of pushing it. And that's just one lever that, syndicator can kind of pull.
Absolutely. I mean, there is a whole host of other issues as far as, how much the payroll is, how the utilities are, you got your contract services and all that. So there's a lot of levers that you still have to consider. You're absolutely right. So now, Elaine, someone like you who have been, let's say, into single family before you scaled your business to now you're controlling, let's say, 3,500 doors in many states now. Could you maybe help our listeners understand how you scale your business? How, what are some of the, highlights that you can share with us that how can someone scale the business to that level the way you have?
Yeah. So it's not really practical advice, but the only reason I was able to scale it that much is I had this silly podcast that people like to listen to that I started back in 2016.
Interesting.
It's like, because the reason I say that is because, I was living in Seattle and, I had coaching to go and do my own multifamily deals, but like the vast majority, I would say 90% or more people fail and flunk out and never get their first deal. Right. And I was one of those people. The reason being is if you really want a good deal, not another garbage 99% deal out there, you really have to actually go visit these properties and build rapport and relationships with the brokers.
Absolutely.
And I just didn't like to do that. And it was just impractical for me to go hop on a plane from Seattle, go down to Texas or wherever.
You're absolutely right. There are, sort of your work, professional life constraints and the physical constraints. I mean, given that you were in Seattle, you were pretty much on the north corner there, and it's almost difficult to do that, right? So let's say your podcast was one. Was there any other elements that you added, perhaps that helped you grow?
Well, I mean, as I was saying, like, I just did the simple math calculation in my head where, I took my net worth and I was like, all right, assuming that these deals, they pay me 12%, 13% IR. I mean, a lot of them are underwritten to be more like 15%-ish.
Sure.
But I just wanted to be conservative because at the time I had built up a pretty good network of other passive investors and, to a point where I had several guys that I could call on and that were in 20 something plus deals. And I was like, hey man, like, how do these things actually really work? Is it all what they say it's going to be? And so that was where I kind of backwards engineered into that 12 to 13% number. So
Interesting.
I just built a spreadsheet, and I was like, all right, this is how much money I have. This is how much money I can invest every year. And this is, if it grows at a 13% IR, where is my numbers going to be by the time I'm 35, 40, 45?
Sure, sure.
And my goal was I wanted to quit my day job as quickly as possible. It's safely
Right,
too.
right.
So I realized that I could do that well before I was 40 years old.
Mm-hmm.
And that was why I was like, screw it. Why would I want to be a general partner, put up all this hard money, take on all this risk? So I originally went down the path of being a passive investor. Just, I knew how to analyze deals. So I was probably better than most in terms of picking the right horses,
Mm-hmm.
is what I figure.
Mm-hmm. Mm-hmm.
So that's what I sought out to do first. And that was my first kind of foray into syndications and private placements.
Interesting, interesting. So now the 3,500 units that you control, these are all passive investments, Lane, or do you have any general partnership stake, or do you are you maybe a strong proponent of investing passively all the time? Just trying to understand.
Yeah, so then the story changed, right? So people from my community wanted to just kind of copy what I did, sort of
Okay.
just whale watch. I don't know why they trust me. Some guy just talking through a microphone on the internet, but they did. So, people started to join me in deals, and to protect them, I went into the general partnership to get control as kind of fiduciary responsibility to kind of protect their best interests.
Mhm.
And then kind of here we are today, basically.
That's awesome. That's awesome. And just for our listeners, Lane has Huey Deal Pipeline Club, which perhaps is his network where I think passive investors are, investing and plus doing deals within his ecosystem. You want to share more details about your club, Lane?
Yeah, I mean, we're a relationship-based organization. I mean, I don't really need to do this for money, but I certainly don't want to work with, difficult people. I want to work
Sure.
with people that are kind of seeing the world from my vantage point, and, understand that, a lot of these deals, you can lose your money, right? But
Sure,
they
sure.
understand that, we're trying our best and acting in the best fiduciary stance we can, right? And being
Absolutely.
good stewards of their money.
Absolutely.
So that's kind of where it comes from. We do put emphasis on vetting our clients, and just kind of I think it's just a lot of people, they just frankly like it that I'm putting my own money into deals, and
Right.
if I lose money, they lose money, and at least it's a big pity party together. I guess if that comes down to that.
Right, right, right. Mm. Awesome. So Lane, knowing your background now and you have a lot of experience, share with us some of the best advice that you have received so far from whether it was, any senior investors or fellow investors so far. Help us understand some of the good advice that you have gotten so far from, others.
Yeah, I mean, one big thing that I tell a lot of my investors is always, being a passive investor in a syndication, you get diversification, different deals, different asset classes, right? Like, I mean, I invest in mobile home parks, not only multifamily, maybe even life settlements one day, oil and gas deals. We can
Interesting.
syndicate everything.
Sure. Mm-hmm.
Sophisticated investors, you got to start out with something, but you got to branch out to different asset classes and get diversification other
Sure.
ways. Like we never know if America is going to start to build class B and C government subsidized housing on a large scale, like how they do in China or other Asian markets.
Mm-hmm. Mm-hmm.
Another thing is, kind of going in with that smaller amount, like that $50,000 investment. It's a great way to spread $1 million all over the place.
Mm-hmm. Mm-hmm.
And then I think lastly, your network is your net worth. The only way to find passive deals is to build up your network of other passive investors that you can call friends.
Absolutely.
And it's more fun that way too. So
absolutely. And goes back to what you said earlier about the 10 20 70 rule that 10% is your education, 20% is all your people, your network, and friends you can trust on, and of course 70% is your action and you're vetting the deals and things like that. So it's been awesome. So thank you, Lane. One last question, like what are some of the things you're doing nowadays to improve your business, whether it's a tool or a practice or any personal things you want to share?
I think just kind of connecting with people on a personal level these days.
Sure.
I think with this whole COVID-19 thing happening, people are kind of stuck with their immediate family units, and I think we've kind of lost touch and just picking up the damn phone and having a conversation, right?
Absolutely, absolutely. Very, very wise advice. Keeps you connected with a lot more people, see what's happening and things like that. And keeps your mental state aware also, because I think being inside, closed, shut down, obviously, there are mental challenges also that come with it. So thank you. I appreciate your time, Lane, today. It's been a pleasure. Our listeners can go on to premiumcashflow.com as well. And there's a clear link for Invest with us where they can register themselves, and we regularly have deals where we are also connecting with investors, and we are happy to jump on a phone call, have a brief discussion about what your investment goals are, if you're sophisticated, accredited, and things like that. So all the investments we do are done with proper disclosure and documentation via SEC. So it's been a pleasure, Lane. I look forward to connecting with you as you grow more of your business. I'm sure we will be back in touch again. And thank you for your time today.
Yeah. Thanks, everybody. Aloha.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.